Good evening, everyone. Mhm. Avec contient trip. Just get on to if I'm not content. Hello? Hello? Can you hear me? Just you can just okay, so today we are going to be talking about cash flow. Wolaju Matthew, can you hear me? Okay, I'll just
Yes, I can hear you.
okay, so okay. Okay, so we'll go on with our class today. I think we are starting very late behind schedule. Not as
Can I contact my colleague if they can come online?
planned. Okay, so we'll see what we can do. Okay. Okay, no problem. Let's see what we can do today and we'll go ahead. We'll meet, continue next week. Okay, no problem. I hope you guys had a great day today. Okay,
Yes, I did.
okay. So we'll just go on with the class for today. Can can you guys see my screen? Can you guys see my screen?
Yes, I can see it now.
Okay. So today we are going to be talking about IAS7. IAS7. And what is this IAS? As we know, IAS is what we call International Accounting Standard. And today we are going to be talking about IAS7, which talks about statement of cash flow. Cash flow, when you hear cash flow, I think one of the things that should come into your mind is that you have cash and flow, that is cash, the cash coming in, cash inflow and cash outflow. So in the layman's definition, can say cash flow is the statement that shows cash inflow and outflow of the organization. But let's go into it deeper. What is the objective of this standard? Why do we have a standard like IAS7? What is the objective? So we said the objective is to provide information about the historical changes in cash and cash equivalents of an entity. So we want to know what happened. What are the things that actually happened? For example, if you are preparing the cash flow statement of 2020, of the year accounting year 2020, want to happen, what are the things that happened? What are the cash and cash equivalent? What are the things that changed as regards cash, the movement of cash either into the organization and out of the organization, both cash and cash equivalent. Now, what is the purpose of this statement of cash flow services? Statement of cash flow is a part of a complete set of the financial statement of an entity. Based on IAS1, we said the set, we have 5 statements that makes up a financial statement. We have the statement of profit or loss and other comprehensive income. We have the statement of financial position. We have the statement of cash flow. We have the statement of changes in equity, and we have notes to account. Now, this statement of cash flow forms one of the part set. What makes up a complete set of a financial statement? Component of a financial statement. Now, what information does our cash flow provide? Like I told you earlier, the objective. We said the cash flow, it shows what? The cash flow of the entity during the reporting period. So the movement of both cash and cash equivalent outwardly and inwardly into the organization, both into the organization and out of the organization. Do you guys get what I am saying? Can you hear me clearly?
Yes, we can hear you clearly.
Okay,
Yes,
okay,
sir.
so let's continue. So what are the benefits? And two, one of the information that the cash flow statement provides again is the changes in cash and cash equivalent during the year, during the period. So when we say cash and cash equivalent, we are saying that things like short-term investment, things that can be turned into cash, that can be turned into cash within a short period of time, like short-term investment, is also a cash equivalent. So what to know, what is the changes? Even our bank overdraft is also a cash equivalent. So all these things we want to see, what are the changes that happen to our cash and our cash equivalent during the period. Now, what can we conclude from this statement? Talking about cash flow statement, we say cash flow statement shows the movement of cash in and out of the organization, and it shows it provides changes in cash and cash equivalent during the period. What is now the benefit of this cash flow statement? We said number one, a statement of cash flow provides information that helps user to evaluate changes in the net asset of an entity in its financial structure, including its liquidity and solvency. So the cash flow statement will provide users to evaluate changes in the net assets of an entity, because the cash flow statement is divided into three, like we can say three compartments. We have the operating activity into three activities. We have the operating activity, we have the investing activity, and we also have the financing activity. So one of the benefits you about the net current asset less current liability. That is our net. So we want to see what are the changes that happen in terms of non-current assets. Did we dispose any non-current assets? Did we acquire any non-current asset during the year? These are the things we see in our cash flow statement. So what are the changes that happen during the year? Did we acquire any non-current asset? Did we dispose any non-current asset during the year? So it helps the user of this statement to know the changes during the year as regards our net asset. When we talk about current asset, we are talking about what happened to our inventory during the year, what happened to our receivables, trade receivables, what happened to, when we talk about current liability, what happens to our trade payables. This will give an information about what happened to our net asset. Now, too, it helps users of account to compare the performance of different entities because, unlike profit, comparison of cash flow are not affected by different accounting policies used by different entities. So, in this case, it helps us. The statement of cash flow, one of the benefits is that it helps us to successfully compare the performance of companies with other companies, your company with other companies. Based on cash flow, there is no accounting policy that is based on cash flow. All we recognize is the movement of cash in and out of the organization. So there is no accounting policy surrounding the preparation of cash flow except the standard what IAS7 prescribes. So it is a good statement that can be used to do what, to benchmark your performance, the performance of a particular company with other companies. Statement that can be used to compare different entities' performance. Three, we said of the entity to generate cash and cash. Can everyone hear me? Okay, so we move to the next point. Say it provides info that helps users to assess the ability of an entity to affect the amount and the timing of its cash flow in order to adapt to the changing circumstances and unexpected opportunity. It gives, like I said, most importantly, cash flow statement. You can assess the ability of an entity to as 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 to how much they can generate, how much cash can this entity generate. No, and you know the number five, historical cash flow are often a fairly reliable indicator of the amount, timing, certainty of future cash flow. We have said that. To assess the performance of management, it can also be used as a tool to assess the performance of management. Now, at the system of cash and cash equivalent, I said our cash flow statement shows the inflow and outflow of cash and cash equivalents. Now, IAS7 requires sources and uses of cash to be analyzed under the following heading. So the cash flow statement is analyzed under the following heading, under the following activities. What are these activities? We have the operating activities, we have the investing activities, and we have the financing activity. What is the operating activity? When we talk about operating activities, we are talking about the revenue activity of it, like some other people will say the the ordinary business doing. So if for example you have what are they calling it, you are into buying and selling of, what are they calling it, semovita. So your operating activity is everything tied to, all the activity ties to the generation of what? Of buying and selling of the semovita. All the activity as regards bringing the semovita into your warehouse, as regards selling it to your customers, all the costs you incurred. You want to know what is the cash movement that happened during the year. You know that The profit and loss statement shows us only the profit. And you know that a company can be profitable and not be liquid. In their what? In their bank account is not commensurate with what? With the profit they have in their account. And why do we have it? Maybe probably most of their sales were credit sales. And you know, if you have credit sales, you will not have cash, but you have people owing you in the they are owing you. So these are the things. That's why the statement of cash flow needs to be prepared along with the statement of profitability to know what is the ability of is this company liquid? Is it liquid enough to meet its obligation? So that is why cash flow statement is also needed. We have talked about the operating activity. When we look at the investing activity, what is this investing activity? We say this one represents the acquisition and disposal of non-term assets, another investment not included in cash equivalent. So we are talking about when you have what do they call it? When you are disposing a non-current asset, when you are disposing, when you are but acquiring a non-current asset, this should be classified under investing activity. So any cash that is generated or any cash that is spent on acquiring a long-term asset or a non-current asset or or other investments that are not included in cash equivalent should be recorded under the investing activity. Then we have the financing activity. What is the financing activity? We said the financing activity is the one that deals with, this is the activity that results in changes to the size and composition of the contributed equity and borrowing of an entity. So for example, we have we, for example, if there's a changes, maybe your company is trying to issue new shares, that comes with increasing the composition of the company, increasing the composition of the company, the size and the composition of the company. So any cash that is being generated through increasing the size or composition of an entity or borrowing of an entity will be recorded under the financial activity. Do you understand? Please, if you have any question, feel free to come to the chat button and type it out for me. If you want me to go back on anything that I have discussed, please feel free to also let me know. Now we move to definition of terms. What is cash? Cash, you can see a cash in hand and demand deposit. So what is cash equivalent? We all know what cash is. Everybody know what cash is. We say cash in hand or demand deposit. That is the one in your bank account. Then we say cash equivalent. These are short term. Are you seeing it? Highly liquid investment that are readily convertible to known amount of cash and which are subject to an insignificant risk in change of value. So one of the things about this cash equivalent is that they are short-term investment and they are not open to any risk. They are not open to any risk. So you can determine the value. You can actually determine the value of this investment. Cash and cash equivalent should have a short-term maturity period of say 3 months or less from the date of acquisition. So we have example of cash and cash equivalents. We have short-term deposits, loan notes, bank deposit accounts, and government security. Now you will see a caveat here. You say equity investments should be excluded because they are subject to a significant risk of changes in value. Now we want to look at what is the format of the statement of cash flow. What is the format of the statement of cash flow? You can see they say IAS7 does not specify a required format for a statement of cash flow. However, it provides illustrative format. It also states that cash flow should be presented under the three headings. We have one, cash flow from operating activities, cash flows from investing activities, and cash flow from financing activities. Under the cash flow from operating activities, the cash flow from operating can be presented using any of the following methods. We have the direct method and the indirect method. You can see under the direct method, you can see cash received from customers as inflow, cash paid to suppliers as outflow. This I have said before that operating activity, when we are talking about the operating activity, we are talking about the principal revenue generating activities of an entity. So cash received from customers as inflow, cash paid to suppliers as outflow should be removed. Cash paid to and on behalf of employees as outflow, cash paid for other operating expenses as outflow, interest paid as outflow, then income tax paid. Now, the cash received from customer can be calculated. So, all these item cash received from customer, it's not just your sales, because your sales might comprise of both your credit sales and your cash sales. So, what we want to derive here is the cash that was actually collected from customer. And to get this, you can see trade receivable at the beginning of the year, add sales during the year, total amount owed by the receivables. You will get it by the addition of the trade receivable at the beginning and sales for the year. Then you will less the trade receivable at the end of the year. What you will get is what is the cash received from sales. This is what the cash received from sales, and it's the same thing as cash received from what? From customer. Now we have cash paid to supplier can be calculated as follows. You have to first determine your purchases. You have to first determine your purchases, and we know that our cost of sales is equals to opening stock for purchases minus closing stock. Now, to make what you have to make purchases the subject of the formula. We have closing cost of sales minus opening stock plus closing stock. We have opening stock is equals to 20, purchases, for example, 10, closing stock is equals to 5, cost of sales is equals to 20 plus 10 minus 5, which is equals to 25. But our purchases will be 25 minus 20 plus 5, which is equals to 10. So to get your payment to suppliers, payment to supplier can be calculated as follows. Trade payable at the beginning, you get it. That's the people you are owing at the beginning. That's your trade payables. Then you add your purchases. This is going to give you the total amount owed to supplier. Then you less trade payables at the end. You will get the cash paid to supplier during the year. And this that we are doing is for what? For the direct method of calculating cash flow from operating activity. I told you that under IAS7, we are not given a format for what? For the presentation of the of the cash flow statement, but we are told to present it under these three headings, which is cash flow from operating activities, cash flow from investing activity, and cash flow from financing activity. But the cash flow from operating activities can be presented through what? The direct method and the indirect method. This is just for cash flow from operating activity. Now, going back, we can see payment for wages and salaries can also be calculated as accrued wages and salaries at the beginning. What are the salaries you are owing at the beginning? What are the salaries that you paid for the year? What are the salaries that you are supposed to pay for the year? Then you will have the amount actually paid during the year that you are supposed to pay for the year. Total wages and salary, less your accrued wages and salary at the end, you would get what? The amount actually paid as wages and salary. Now we move to other cash paid can be calculated as follows. If you have administrative costs, distribution costs, other operating costs, total operating costs. Now we can list what? Other non-cash item. Depreciation. Depreciation is a non-cash item. Amortization is a non-cash item. Impairment loss is a non-cash item. Loss on assets is a non-cash item. Increase provision is a non-cash item. That we have, will now get the total cash paid during the year. Now, for interest paid might be different from interest charged in the income statement. For example, if we have accrued interest, if we have accrued interest at the beginning, then you will add the amount of interest. The tax paid, you have to get accrued tax at the beginning of the year, that is both current tax and deferred tax. Both current tax and deferred tax. Please take note, then add the tax that is charged for the year. Then less accrued tax at the end of the year, both current and deferred tax. Then you will get what? Your tax paid. You can see this is using the direct method to calculate your cash and cash equivalent from operating activity. If you are to use the indirect method, you are supposed to get what? Profit before tax. From your what? Where do we get our profit before tax? Where are we going to get our profit before tax? From our statement of profit or loss account. So you pick your profit before tax. What are you hard what? Hard back non-cash item. This non-cash item are assumed to have been subtracted before we got our profits before tax. Now you will do what? You will add them back because what we are doing is what? Statement of cash flow. Depreciation is not a cash item. Amortization is not a cash item. It's not a movement of cash. Loss on asset disposed is not a cash item. So you do what? You will add it back. Then gain on disposal of plant and machinery, you will subtract it. Decrease in provision, you will do what? You subtract. Interest expense, add. Interest income, minus. Why are we doing adding back interest expense? Interest expense is a wrong classification. Because it's supposed to be under what? Our financing activity. That is why we are adding it back. Then when we get to the financing activity, we are going to do what? We are now going to subtract. Then the next is to do movement in working capital, changes in trade and trade receivable, plus or hard if there is. When we do a question that I understand is Malta. This is working capital and our current liability. Current asset and our current liability. Then we interest profit paid, subtract net cash from cash operating, net cash from operating activity. Note, increase in current assets will lead to an outflow. Why? Because while decrease will lead to cash inflow. What we mean is that if you have increase in, for example, your trade Okay, so as I was saying, I say for example, if you have a receivable, a trade receivable, this last year you had 200, and this year at the end of the year you had 120. What has happened? There's a reduction. That means you have recovered 80,000 naira from your customer. That is what? A cash inflow. But if you had 200,000 as at last year, as at 2019, and in 2020 you had 220, what has happened? You have increased your trade receivable. That means you have given people this. That is what cash outflow. Then we look at increase in current liability. Increase in current liability will lead to cash inflow. What it means is that, for example, if you had trade creditors, you had trade creditors who gave you goods on credit. What it means is that you have more money to use to do your business. That means you are not paying people are giving you goods worth, let's say for example a trade payable like 200, but you had 210. What has happened? People have left their money with you, so it leads to what? A cash inflow. Why decrease will lead to cash outflow. Now, cash and cash equivalent will not be considered when calculating movement of working capital. Are you getting it now? You are not, note, you are not to consider what? Your bank, when you are calculating movement in working capital or your bank overdraft. You are not to use it. Now we move to invest cash flow from investing activities. This is just the format. Remember, the direct and indirect method is just used for calculating cash generated from operating activity. Why for cash flow from investing activity and financing activity are the same, even if you use the direct method and indirect method. The direct and indirect method only affects cash generated from operating activities. Let's look at the cash from investing activity. This includes both inflow and outflow, but only those cash outflows that result in recognition of an asset are eligible for classification as investing activity. So if we have cash paid for purchase of non-current asset is an outflow, you paid cash. Cash received from disposal of non-current asset, that means is what? There's a cash inflow. Cash paid to acquire a subsidiary, you minus, is an outflow. Cash received from sale of shares in subsidiary is an inflow. Interest received, dividend received from investment, cash received, you had it as part of your investing activities. Now, for you to calculate your cash paid to acquire non-current assets, you have to test. You have to test because in the question, remember when you are to prepare your statement of cash flow in the under exam condition, you will be given 1 year profit and loss account and 2 year statement of financial position account. In most cases, that's what they give you. In most cases, that's what they give you. So, for example, for you to be able to derive the cash paid to acquire non-current assets, look at the format. Assets at carrying amount at the beginning of the year. That's your non-current assets. What is the carrying amount at the beginning of the year? That's for last year. That would be the closing balance for last year. For example, if you are giving statement of financial position of 2019 and 2020. So what it will be is that your opening for this year will be 2018, the carrying amount of 2018. And when you are doing asset at carrying amount at beginning of the year, it will be for 2018, and at the end it will be 2019. Now we have asset acquired under finance lease had it, upward revaluation of assets, you had it, depreciation charge for the year, you subtract. Are you seeing it? Carrying amount of asset disposed during the year. Please don't make mistake. It is the carrying amount we are going to remove, not the amount the asset was disclosed. Note, it is the carrying amount you will use here, not what? Not the amount the asset was disclosed. Then we have provision charge to asset during the year. You have the downward revaluation of asset. If there's a downward revaluation of asset, assumed carrying amount of asset at the end of the year, less closing carrying amount given. So if they are definitely, I told you that the statement of financial position that you are going to be given will be for 2 years. So the closing balance, you will compare it with what you calculated, then you will get a balancing figure. Now, cash received from asset disposed. How can you calculate cash received from asset disposed? Or you say cost or revalued amount of the asset disposed, less accumulated depreciation, then you get the carrying amount. Then you get the carrying amount. Then you get the carrying amount of the asset disposed. Then profit or loss on disposal of asset to get the cash received for asset disposed. Note, profit on disposal will be added to the carrying amount, while loss will be what? Will be deducted. Then we move to here, cash flow from financing activity. I told you that the cash flow from financing activity are both the cash inflow and outflow that result into the increase in the size or composition of an entity. And what? And the borrowing company. Cash flow from financial activities. Look at what we are looking at. Cash proceeds from issuing new shares, proceeds from a new loan. If you acquire a new loan, is what? Is an inflow. Cash paid to resume shares or payment of finance lease obligation is an outflow. Dividend paid to shareholder is an outflow. Interest paid is what? Is an outflow. Do you understand? Do you understand? Now, note, dividend paid might be included as operating cash flow instead of financing cash flow. Interest paid might be included in operating activity as well. Emphasis is much on equity and non-current liability item. So we are saying that some school of thought believe that dividend paid can be part of operating activity, and interest paid can be part of operating activity. And immediate issue is calculated as opening share balance plus bonuses issued during the year minus closing balance of share. We will get all these things clearer when we solve a question. Now we see also share premium is the same there is an imbalance and vice versa. There is an outflow when what? When closing balance is less than opening balance. Now we have here where dividend paid during the year is not given. Retained earning can be adjusted to reflect this. This can be calculated by adjusting opening balance of retained earning plus profit for the year in the income statement minus closing balance in the statement of financial position. Balancing figure represents dividend paid. We are going to see that finance lease obligation is derived by adjusting liabilities at the beginning, both current and non-current, plus asset purchased on lease during a minus liability at the end. We will see it clearer. Let's look at this question just to see what we have been saying about the cash flow statement, IAS7. I told you that the cash flow statement is divided into three what? Into three headings. It should be presented under the operating activities, the investing activities, and the financing activities. I told you that the operating activity deals with what? The principal revenue generating activities of an entity. Then the investing activity deals with what? The acquisition and disposal of long-term assets and investments which are not categorized as short-term investment. Now, let's look at this question. Question 1. Financial Limited. You can see give you statement of financial position. How many years? 2 years, 2014 and 2015. Just I told you that they will give you the statement of financial position of the 2 years. Then we have what the profit. You can see profit and loss account for only what 2015. Look at the additional information. Operating expenses includes depreciation expenses of 66,000 and charges from prepaid expenses of 4,000 naira. Land was sold at carrying amount for cash. Cash dividend of 110 were declared and paid in 2015. Equipment with cost of 332,000 was purchased for cash. Equipment with a cost of 82,000 and a carrying amount of 72,000 was sold for 60,000. Bonds of 20,000 were redeemed at their face value for cash. 260,000 ordinary share of 1 naira each were issued for cash. 60,000 ordinary shares were issued in exchange for land. Prepare the statement of cash flow for Abuja Limited for the year ended December 31st, 2015. Now, this is our solution. We want to try and use what? We want to use both the direct and what? And we want to use the direct and the indirect method. So follow me carefully. Follow me carefully so that you can get these things right. This is the statement of cash flow for the year ended December 31st, 2015, using the direct method. I told you that the direct method only affects the operating activities. The direct and indirect methods only affect the calculation of our cash generated from operating activity. Now, look up. Cash flow from operating activity 1696. How do we derive it? I told you for flow cash received from customers, it is not only your sales, because it is assumed that your sales might be a combination of both your credit sales and cash sales. But what we need here is the cash received from customer. And how do we go about this? You will go about it by saying what cash received from customer, what is our sales, what is our sales, what is our sales? Go back to your question. What is your sales? You can see revenue of 1.60. What is our sales? are the things we have as receivable? Opening receivable is what? Is what? Opening receivable 2014 is what? Is 52. 52 plus 1,780. Someone pressing calculator. 780. 170 plus 52 minus the closing receivable. Minus the closing receivable. That is how you get what? That is how you will get your what? Cash receipt. What is our closing receivable? Our closing receivable is 131,000 minus 131. What do we have? We have what? We have 1696. 1696. 1696. So this is what? The cash receipt. Sorry. This is the cash receipt from customer. Now we move to the cash. I told you that for cash pay to supplier, you are going to get the purchases. Now we are giving what? Cost of sales. We are giving cost of sales. And you know, I told you from the question, our cost of sales is what? Our opening stock plus purchases minus closing stock. So to get the purchases, we will make purchase the subject of the formula. So the formula will now be cost of sales minus opening stock plus what? Plus closing stock. And our opening and closing stock, we can see it inventory. We have 131 and 7,000. So to get our cash, you can see purchases 1,054. You will see that it's not the same thing as in your cost of sales. What 938. What they've done is that they have subtracted the closing, the opening event on it, and they have added what? So after you have gotten that, you will now add what? Your opening payable and your closing payable. You can see in this thing, what did they do? They just did difference in pay. Difference that the close. What is our opening payable? We have 80 in 2014 and 46. So you are supposed to add the opening from it and less the closing. So 80 minus 46 will still give you what? 46. So you have to add 46 to what? 80 minus 46 will give you 34. So you have to add it to it, then you get 1088. That is how we got what? Our cash received, or our cash paid to supplier. They will now move salaries and other expenses. How do we get salaries and other expenses paid? You look, other expenses, go to your where are you going to get this? In your profit and loss account. And I told you, what are the things you will not do? You will not remove depreciation. There is depreciation. They said operating expenses include depreciation expense of 66,000 and charges from prepaid expenses. Prepaid expenses. So we have depreciation, other expenses 6,000. Decrease in prepayment, increase in accruals. You have to consider that because Expenses can either be prepaid or accrued. Now, if you see, we have what in this our assets, we have prepayment, and we also have what? We also have accruals. Since they are not trade payables and trade receivables, this relate to expenses that have not been paid or expenses that have been paid, that or probably prepayment people have overpaid in terms of what this maybe we have overpaid our expenses. That's prepayment, and it's an asset to us. It's an asset. This will be what you can see. Let's see. You can see in our workings. You can see we decrease in prepayment, increase in accruals. We are reduced, and we got what 352 naira. If you subtract this from your cash received, your cash flow for operating with 250. We tax. I said how we get our is opening. So how do we get our tax that will be actually paid? We said opening tax. In this question, do we have deferred tax? Deferred tax. Go to your statement of financial position. This is where you see is you can see tax payable, tax at the beginning. So the standard is what? The standard is to get your tax paid, opening tax plus the tax charge for the year. So 37,000 plus 130, 130 plus 37,000 minus tax at the end. Minus the tax at the end, 58 minus 58. This will give us what? 109. Subtract 109 from 256. This is what? Your cash generated from operating activities. Your cash generated from operating investment activity, purchase of improvement. Mind you, if in the question they said that what profit on disposal of assets is part of our profit and loss account, what will you do? You will do what? You will remove it. You will remove it. But if it is loss, you will add it back. I think we should stop here tonight, and we'll continue next week Friday from here. We will have covered everything, but speak up now. You want me to explain? You are not getting something well. Please speak up. Let me know. Hello, everyone. Do we have any question? If we do not have any question, I think we can continue this class next week, Friday. Thank you very much for your time, and see you next week, Friday. Thank you.